Now we get to turn towards the U.S. export market and what is happening in the international world. And we'll touch on a little bit of what we were expecting for OPEC, what we know so far, and how is this going to shake out going forward. And before we get into it, please like, share, subscribe. We appreciate your support. And if you have any questions, please put them in the comments. And then again, we do have our report coming out that's just going to look at how many spreads, how many completion crews are out there, how many are being marketed, where's the horsepower, what basin, pretty much a wide sweeping breakdown of U.S. fracking production. When we're going to tie a nice little bow around it, talking about NGLs and what do we expect in the international markets on a liquids basis. So that kind of leads us well into where propane exports are, but let's just take it in order. And here you can see gasoline was down small, 710,000 barrels. Again, kind of holding in where we thought it was going to be, based on the averages. Distillate, a nice little bounce, 124,000 barrels. Again, it's right in line with where we were expecting it to be. The biggest one really is the LPG continues to be robust, up on 198,000 barrels a day at about 1.5 million barrels a day in aggregate. And the benefit is when we look at the year over year, the 5-year, we're going to have trouble looking at that just because there's new facilities online. So with new facilities, we'll inherently continue to shift higher and be able to hold above that. And just given with the Saudis, with their production cuts, there's less propane and LPG in general coming out of the Middle East, which is putting more people, and especially India, looking to purchase. India, South Korea have been two big buyers, and China of LPG, and that's something that is going to continue. The one that was a big surprise, again, 625,000 barrels a day increase in U.S. exports. We were expecting a little bit of a slowdown to about 2.7 heading into Thanksgiving week. Instead, we had the exact opposite. We had a big increase to about 3.45 million barrels a day. Again, it's all timing, and it's all about who is buying what, when do they want delivery. And now as we go through and as we look at spreads, spreads have opened up a little bit, not by much, where LLS and Brent is now about $1. But again, it's not 70 cents. It's at $1. It's widened out a little bit more than that previously. And these are going to be things to watch to see how many new purchases or what new cargoes could be purchased as we head into January, February, especially into Asia, because Europe remains fairly closed for U.S. exports. So these are going to be things to look at. Obviously, we think things are going to normalize as they come down, but obviously it's just a matter of where. It'll probably come closer to that 2.8, 2.9. But again, it's just those lumpiness that we're going to talk about. And then we actually have a new chart looking at the seasonality side and trying to look at where do we think oil exports will be. Talking about gasoline exports, we expect them to remain above that 9-year high. As you can see on a seasonal level, if we look at that 9-year average, we typically drop. So again, nothing too crazy. Just based on some of the strength in Latin America, Colombia, Brazil, some of the other, Mexico's the odd man out that's still seeing a lot of trouble. Those countries either import from us or they'll consume more of their own, which will then help support some of our exports. So gasoline is one that we think it's going to maintain above that 9-year average. It's not going to be these explosions back to the top of that cloud, but it's something that we think is going to be able to maintain some fairly strong or at least stable growth through the end of the year. The one where we continue to see problems, as we talked about, we got to the bottom of the cloud. We thought it was going to bounce. It bounced, but again, not all that much. It'll still stay well below the 9-year average just because there's so much product coming out of Europe. There's a lot of product coming out of Russia, which is something else, another one that we'll talk about. Same with the Middle East in terms of just flows in general. And that's going to put pressure on U.S. exports. Now, this may sound terrible or may sound weak, but we do have strong internal demand. So even though the export market is a bit weaker, the internal market or within the U.S. market remains fairly robust. So it nets out to essentially a wash, which is why we still remain net bearish on total product demand, but distillate on an internal level remains strong. It's just these exports are going to continue to remain weak to the down, and really go sideways. We'll probably shake out of the cloud and see additional pressure, but again, it's not going to be anything back to the 9-year average. Now, looking at crude oil export data, here you can see that we have a fairly robust export moves, and obviously you can see the lumpiness with it. Obviously, just to put some color behind it. So in 2014, at the end of 2014, they President Obama at the time lifted the export ban on U.S. oil. So that's why when we look at 14 into 15 into 16, it takes time to really ramp that up, and get facilities online, get things turned around so that we can export more. So it wasn't really until 2017 that we really started to see an acceleration. And that's why each year we've seen a pretty steady increase, with obviously 2019 setting new all-time records. Obviously, 2020 has its own issues. We're not going to achieve the records that we did in 2020. It's going to be more of 2019 is going to be more of an average of 2018 and 2019. And that's why you can see the lumpiness. So this is one where we think that we're going to come back down, but we will stay fairly strong just because we do have a lot of oil. It has to be priced to move because we don't want to have the same implications that we had when crude went negative. We can talk about how much criminal or insider or cornering the market happened to do it. But again, we also don't want to see $20 oil. And these are things that are going to continue to keep things moving, especially when we look into refiner throughput. So, and as we go through the remainder of this segment, we'll talk about how we're seeing bids for specific grades. And that's what we need to look at, of how does the U.S. kind of fit into some of the grades available, as we did see some tightness in the OSPs, or the official selling prices, which is putting a little bit more support into the U.S. market than we initially perceived. But again, it's going to also depend on what is happening with the OPEC agreement. Just touching on Fujairah, so we did get a total increase of 2.3%, which was really driven by the heavy side. When we talk about this, we've been talking about how light and how important light and middle distillates are. And middle distillates is the big one, and it had a nice drop of about 12.8%, which is about 786,000 tons. And when we look at this, we're like, all right, well, put this into context. So overall, the drop was 12.8% to 5.375 million barrels, down from the record high of 6.161. Again, we were at a record high. They had to be priced to move. There was always going to be storage issues. You want to make sure that things are moving. So it's going to be seasonal. It's going to be adjustments. This is one where we think there's going to be a little bit of a continuous draw. But when we look at China and how they set a new record of diesel exports, which will continue into December, it's going to backfill, especially as we look at Singapore. And even though we did get a nice draw, again, we're still near all-time highs, and it's not something that we think is going to draw down too much. Light distillate, came down small, about 1.4% from a 10-week high. Again, all of these are just going to remain elevated as we go into the end of the year. Now, we showed this last time. It's worth repeating just because this leads into the issues that we're seeing right now in OPEC. For those that read our report that came out ahead of the OPEC meeting, what did we say? We said the base case was an extension for 3 to 6 months, which was really 3 months or a quarter, with another meeting in March. The bull case was we get a cut of 500,000 barrels a day to 1 million, essentially trying to offset Libya. And then the bear case is an increase of 1 million barrels, which an increase of 1 million barrels plus the increase of Libya by 1 million barrels would be that 2 million that was expected January 1st. Now, the UAE cheated, and we have a chart showing just how much they cheated in 2 months, and then they quickly rectified the situation. The big issue now, and you have to appreciate the political dynamics, the Saudi can't come out and yell at Russia saying, you guys are cheating. They need someone else to do it, but they need someone else to do it within reason. Unfortunately, I think they underestimated how angry the UAE really was on how they were called out for cheating, and yet no one else is, and no one else has made up the cuts the way they have. And that's why if you look at this OPEC compliance, even with those 2 months, UAE is still over compliant by about 8,000 barrels a day. So again, you have Russia that's over by about 90,000 barrels, Iraq that's over by 101,000 barrels, Nigeria over by 35,000 barrels a day. And this is going back to May. That's why the UAE is sitting there saying, this isn't right. Like, if we're going to continue this, you guys need to cut. And as we all know, or those that have been following us, cheating is going to increase, because now we know that there won't be any fallout for cheaters. And if you're not going to get penalized, why wouldn't you continue to cheat? Because if you don't, then what is going to happen to your balance sheet? And that's where we look at, if you can't get price, you'll get volume. And when we look at Iraq, Russia, Nigeria, that's what they're really doing, which is why the cheating will continue. There's no real ramifications, which is what the UAE is calling out. Now, because of that, that is why we have seen a delay in the overall agreement. They want to show a united front. And something that typically doesn't happen was there seems to be some commentary out of Saudi Arabia and the royal family saying they should just open the floodgates again and have another price war to essentially, I don't want to say, what's the best way to say it? To penalize those that are cheating. It's like, you guys don't want to play ball? Well, this is what we can do to you. Now, we all know that Saudi Arabia and a lot of the other GCC countries are also struggling on a balance sheet level. So again, it's going to be very difficult to see, especially when you look at Saudi Arabia, which is over compliant by 197,000 barrels a day. Now, when we look at, again, what could a price war look like? What could the fallout be? And you can see that the first OPEC plus deal fell apart, and that was what really sent us into that, let's call it high single digits to low teens. And then they came together to have the second OPEC deal collapse or come together. And then now we're starting to see them realize that they can't do too much. But with 8 million barrels a day of spare capacity, with 3 to 4 of it able to come on fairly quickly, it's really hard to see a sustainable move to the upside, especially with demand destruction, demand pressures all over the place, which are only increasing or at least remaining fairly stable. We're assuming that we have demand destruction. We're going to say that it's between 87 million barrels a day to 90 million barrels a day. I know others are out there at about 93 to 94. Again, these are things where we've continued to see the IEA, the EIA, OPEC come closer and closer to our demand numbers. And these are things that I think are going to become a bit more normalized. Now, this is just looking on the aggregate, OPEC total crude production quota and total OPEC estimated crude output. Clearly, they've been cheating, and cheating is something that has been happening for years. So this is not something new. It's just there are more ramifications this time than previous times, especially because the pace of declines of storage remain slow. They're happening, but they're happening along the seasonal norms. The slope needs to adjust. They need to see a more aggressive drawdown. And with the cheating and the fall in demand, we're just not seeing that. So the 12 OPEC countries, including Russia, overproduced by almost 400,000 barrels a day every month between May and October. Russia, again, that 90,000 barrels. And when we look at November, so if we look at November numbers for Russia, they're above by 118,000 barrels a day. So again, slowly continuing to creep higher. And this is on top of Libya coming back and putting additional pressure on the overall physical market. So when we look at the physical market, Angola has sold 19 out of 38 planned export cargoes for January. Now, the pace started out lightning fast. And we were sitting here saying, wow, like West Africa crude is moving quickly. And then it started to slow down fairly aggressively, and it started with Urals, where Ural prices day over day started to decline. They spiked to a strong premium, and then the premium quickly dropped off. And we saw something similar. So Angolan cargoes went immediately up $1, and then fell back to about 50 cents. So, and now we're starting to see those cargoes slow down. And now as we head into the end of the month, we actually have cargoes that are being unsold. So, and again, as we talked about last week and the week before, we saw something very interesting happening with Urals. And the same thing appeared in Angola. And then when we look at what is the loading schedule, so Norway so far is letting so they were part of the OPEC plus cuts when we looked at, the partners or those that were outside of the OPEC plus agreement technically. But they played ball, and they're going to let them expire in January. Now there's a potential for another strike, which could put some additional flow under pressure. But again, these are just early indications for January. Nigeria's walked back a little bit. Angola's fairly flat. We've seen some deferrals, not too much, as we've seen a little bit of a pickup, obviously with China buying a bit more, India buying a bit more. But now India is talking about how their SPR is getting close to full as they've expanded it. And now the question is going to be, is China going to continue to buy? And they've been very specific on the cargoes and the types of crude. So we're seeing some tightness in specific heavier cargoes, a little bit weakness in some of the lighter cargoes. And these are things that we're going to have to continue to watch as we head into Lunar New Year, because that is typically when China really drops off. As if you're buying right now, you're going to take delivery in February, and then this won't enter a refiner till March or April. And and as we'll talk about in our report, there is a lot of petchem coming on and refining coming on that they have to kind of prepare for. But when you look at Chinese demand, you also have to look at Chinese exports. And again, we're continuing to see record amount of exports, which is putting pressure in the international markets, which is limiting the amount India can export, South Korea can export, which again, even though they have seen a little bit of an increase on domestic demand, the international markets still remain oversupplied. Now, it's important to look at Libya. So just a quick geopolitical backdrop. So right now, there is a fight between the central bank and the National Oil Corporation in terms of who has the money and who gets the revenue. So the NOC has frozen incoming oil revenue, denying them to the central bank. So this is a problem because how do you share the money? How does it go through? Because you have oil guards, and the oil guards need to be paid. And then you obviously have Haftar, and then you have the Tripoli, the Tripoli and the Benghazi side of the equation. Now, when we're looking at this right now, there is no money to keep the embargo or to restart the embargo. The UAE was the pass-through for the GCC to pay General Haftar to not produce oil and to keep the embargo in place. The UAE yielded, Russia yielded, Turkey yielded, and the same day Turkey agreed to the ceasefire, they also tested the S-400 system, which is a missile and an anti-missile, air defense. And those together mean that, look, Turkey's done. They have other problems. They have a weakening economy. They're looking at Azerbaijan, Armenia. They're dealing with problems with Europe, specifically France. So even though there is a fighting back and forth as to who gets the money, we don't have the same proxy influences we have previously because, one, their balance sheets are stressed to beyond belief, specifically Turkey and Russia, and they have bigger geopolitical issues to focus on, and Libya is no longer a part of that. So even though the money is a problem, there's just not the willpower nor the capital to pay someone to cap oil. Now, that's just a long way of also saying we think that we're going to stay at about 1.2 million barrels a day, which puts about 1 million barrels into the open market. Again, this is well ahead of where we thought. We were assuming 750,000 barrels by the end of the year, and they're at 1.2. So we're on the bearish side of the oil equation, and yet we're wrong to the wrong side of Libya and U.S. oil production. So now when we look at UAE production, this is important because you can see May they were good actors, June they were good actors and made up for the little bit that they overproduced in May, and then July and August was when UAE overproduced. And I'm sure they were thinking, look, I've been footing the bill from Libya. I need to make back some capital, and then they snap back into compliance. Now they were called out by Saudi Arabia, they made the compliance in September, and then they made the over compliance in October to make up for it. And now they're saying, look, I did it. I was a good citizen. Why isn't Nigeria doing it? Russia, Iraq. And this is where a lot of these pitfalls and a lot of these problems continue to arise. And this is what now, with all that being said, there will be a deal. It will be for an extension of cuts through Q1. I just expect way more cheating. And Libya is just going to continue to pump at 1 million barrels. So you could say, look, keeping things the same and delaying the increase in production is effectively increasing by 1 million barrels a day because Libya wasn't part of the initial, and they have free reign to do so. So again, no cut equals 1 million increase, which the market has already priced in, or whatever the market likes to price in, because they climb that wall of worry and price everything to perfection. So now on the more bullish side, when we look at crude oil held in storage, again, it's at least 7 days stationary. They fall into the lowest level since April. It was down 5.4% to 117.72 million barrels on November 20th. Again, always looking at timing delays, so some of the things will be a little adjustment. The problem is the pace has really slowed, and now we're seeing some slowdowns in India with new cargoes being purchased, but slowdowns internally. China, the SOE refinery run rates have started to increase a little bit, which is a positive. But again, they're coming from pretty weak levels, which is going to put additional cargoes on the water. But again, it's just a matter of where we're seeing some of these increases. So the lowest level in Asia, so since May, so Asia's down 14%, but Europe's up 20%, which is what we were talking about. Again, these timing delays in terms of when is it in Europe, when does it get shipped to Asia, and these are the adjustments. The one that we've been watching is the Middle East. So the Middle East is up 71%. To 10.3 million, which is the highest since July. So if you consider about where we were in July, you can see the elevated levels. So the question is, how much of that gets kicked out? Where does it sit? North Sea is up 22% to 8.7 million. Again, those timing delays that we keep looking at, which if it's stored there, it'll end up in, at this point, just based on who's the buyer, it's going to end up in Asia. So it could just go from the Middle East, from North Sea, from Europe into Asia, and you'll just see a movement. It's just how can Asia continue to pull it off the water? Can South Korea, Japan has been fairly strong. Unfortunately, the numbers got put behind a paywall, so it's difficult for me to get them. And there are things that have gotten in the way of that, but Japan has increased. South Korea is fairly stable. India is slowing. China, we think, is going to continue to slow down, not refinery run rates, but in terms of their purchases as these crudes that they've purchased get delivered, end up at the coast, will turn into floating storage, waiting for space to go on land. And those are things that we continue to see when we look at it on an aggregate level as we consider crude oil on the water remains fairly stable. So even though we've had oil floating storage coming down, we have oil in transit increasing, which is putting, again, that timing delay as to when is it in transit, when is it in storage, and that's where we continue to see some of this slowdown as the pace has flattened out and we're not seeing these big drops as we've seen previously, which again just speaks to some of the pressures that we're experiencing in the physical market, but it is specific to crude grade. And now just breaking it apart piece by piece, here you can see Asian floating storage obviously well above where it normally is, but still moving with a new low being made, coming back to those May levels. This is one where, as we've been saying in terms of the slowdown, we're expecting, again, that timing where things are just going to flatten out. You can see the massive increase, and now we're getting we had a nice steady drop, and now that drop is starting to slow. And this is also a seasonal issue in terms of Golden Week, Lunar New Year, which are going to get in the way of when some of these things move around. The North Sea remaining in the top of the cloud. This is one that we think is going to continue to increase, especially given where production is expected and loading schedules look heading out of the North Sea, Norway in general. And just given where the refinery run rates remain fairly low. And now the Rhine River, so not only does refined product come down it, you send oil up it. And without oil being able to move up through the Rhine, that's going to put more pressure and put more crude back on within the North Sea and Europe, depending on which side of the water they fall under. Now, West Africa is one that we've said is going to remain elevated. It just went flat. Not much has changed, and it's really driven based on what is happening between Nigeria and Angola. Angola has seen a slowdown in sales, which is putting a little bit more in floating storage, and the same with Nigeria, because right now Nigeria is competing more aggressively with Libya. And with euros dropping, we've seen Nigeria get a bit more aggressive with their pricing. They're expected to get a new loan, which will from the World Bank, which will help kind of bridge some of that gap. But again, the pressure remains throughout West Africa. The Middle East, just to kind of put it into context, we break it out a little differently just because 2016 was such a massive number. So here you can see we're breaking out to the top of the range as we go through 2019, 18, 17. And this is one that we think is going to continue to increase, especially as we have Iraq continuing to produce over their allotment, with Basra crude being a big driver of that. And then when we look at the GCC countries, we're seeing more and more crude get stuck. And it's when you look at China and what China's buying, China's skipping specific grades. They've picked up Azuri, and now after skipping it for 4 months, they've reduced Urals by a big chunk, picking up Azuri. And now, again, it's just going to come down to who has the crude that they want, which is going to put a bit more Middle Eastern crude on the water. This is just rounding it out. Europe remains elevated. Top of the cloud. This is one that is going to continue to kind of walk that wall and continue to move higher over the coming weeks. Shifting into as we look at just product in general. So this is again the snapshot from last week as this data comes out tomorrow. And gas oil, had an increase of 103,000. Gasoline small draw, but again, gasoline is near all-time highs. Gas oil is a bit more normalized. But again, these are just going to be, this is supporting just additional flows and just showing how we're going to continue to see exports out of Europe just because they don't have the demand. They still have elevated storage, and there's an open market just based on where things are in the U.S. The other side of it is Primorsk is a Russian area. You can see diesel loadings are increasing just because, again, Russia is under a big COVID wave themselves. So their economy has come under pressure, which, again, is putting more diesel on the water, not only in terms of just their increasing refinery runs, but they're also seeing less demand internally, which is putting more diesel into the open market, again, putting pressure on just the international pricing. As we see China increasing exports, India maintaining pretty stable diesel exports, and again, putting that pressure that we continue to see, and it's showing up in Singapore. So Singapore had a build of about 2 million barrels as we looked at it week over week. So it says December 2nd, but it comes out actually December 3rd. So this will come out in the overnight. The bigger issue that we've been talking about remains middle distillate. So when we look at this on the aggregate, you can see the stock overall remains elevated. Again, new all-time highs on a seasonally adjusted level as we should be falling. And as we see Russia coming out, India, China pushing more product into the international market, it's starting to get stuck here. And this is just showing just why we remain concerned on just total demand, because we need to see this really start to normalize in order to get those refiners to really start to increase their activity and to kind of wake up from their sleeping, their COVID slumber. When we look at middle distillate, again, as you can see from just the chart and the seasonality, it's a new seasonally adjusted all-time highs. It's off the highs that we saw in the beginning of November, but again, the trend continues, the slope continues to move up, and just given where diesel demand is, with India weakening year over year, with China staying fairly stable on internal demand, but increasing exports with Russia, again, this is where a lot of that's going to reside. Now, just touching on run rates, as we talked about the state-owned side, they continue to be fairly weak. This is at the bottom of the average. And it's really driven because we are seeing some demand increase internally. It's still below what was expected, but the export market remains one of their big focal points. And we should start to see this flip where run rates will drop out of the teapots, which have remained very strong at 75%. And again, the teapots can push inward and also into the export market, and they're seeing their margins obviously come under pressure just given the amount in the floating market, which is why we'll start to see them slow down, which they normally do on a seasonal level, just as export quotas start to get capped, import quotas get tapped for the end of 2020, and then they rejuvenate in 2021. As we've talked about, I think it was 3 or 4 weeks ago. So the state-owned side, we'll start to see some love getting to about 77%. But again, it'll still stay fairly reserved just given the amount of refined products they have sitting in storage. And this is just putting into perspective, as refinery storage levels in China going flat, but at the same time, you can see that they're pretty stable, and just based on where things are, it's going to be timing. We think they'll hold over that 40 million level, but again, just based on just timing of when can they get it off the water into a tank is going to be something to watch. So a lot of information out there. We'll have an OPEC show on Friday covering what happened. We'll film it Friday. Hopefully we'll get it out on Friday, if not Saturday morning. Really looking at what does this OPEC deal mean? What is it pointing to going forward, and digging in a little bit more and trying to, put that into context as it relates to the U.S., especially with the problems we remain to see in the refined product market. So thanks again for watching. Stay tuned. We have the Econ show coming up. Obviously, our favorite, the Primary Vision Frac Spread Count, and then our special OPEC show. So thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.